Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie. It's great to be back. Our aim today is really to cut through that constant flow of information.
Exactly. We want to help you stay informed by diving deep into the week's key developments, political shifts, economic data, regulatory changes.
We'll connect those dots and figure out what they actually mean for you working in the sector day to day.
So let's get started. First up, some quite unexpected political news that broke on September 5th. Angela Rayner resigning.
Yes, that certainly caused a stir. The core issue was her admission of underpaying stamp duty around £40,000, it seems, on her second home.
It followed a lot of media focus, didn't it? And she herself said, quite directly, "I deeply regret my decision to not seek additional specialist tax advice."
It really highlights how personal financial matters for public figures can escalate. But beyond that, it's a reminder about due diligence, isn't it? For everyone.
Definitely. Getting the right advice, especially on complex tax situations. Does this kind of thing change the public perception of financial compliance generally, do you think?
I think it can. It puts a spotlight on getting things right and perhaps reinforces the importance of transparency. For banks, it underlines the need for robust processes, maybe especially when dealing with, high-profile clients or complex arrangements.
Right, sort of reputational ripple effect. Okay, let's shift gear to the economy. The ONS, the Office for National Statistics, had to correct some retail sales data.
Yes. For the first half of 2025, they admitted they'd initially overstated monthly volatility. Basically, their own words, the economy appeared stronger than it was.
That sounds significant. Can you give us the specifics?
Sure. So January 2025 growth was first reported at plus 1.4%, the correction, a drop of 0.4%. That's quite a swing.
Wow, okay.
And May 2025, initially reported as a 2.8% decline, was actually only a 1% decline. So less bad, but still wrong.
So the overall picture for the first half of the year is now, well, slower growth, despite a bit of an uptick in July.
Precisely. A slower growth narrative. And that, of course, has implications for economic policy, potentially for retail banking strategies, too, if consumer spending wasn't quite as robust as thought.
It really underscores the need for reliable data, doesn't it?
Absolutely. The ONS apologized, and they're planning changes moving to calendar month reporting by late 2026. But it's a stark reminder for everyone relying on these figures, you need good data for sound decisions.
And speaking of decisions, let's talk Bank of England. Governor Andrew Bailey has sounded quite cautious recently.
He has. He warned MPs there's considerably more doubt about when future interest rate cuts might happen. This is even after that small cut to 4% back in August.
What's driving that doubt?
Primarily inflation risks. It's projected to hit 4% this year, which is, double the bank's 2% target, plus ongoing weakness in the labor market.
So no quick return to lower rates then, it seems.
Doesn't look like it. Bailey also tried to sort of downplay the rise in UK long-term borrowing costs, pointing out it's a global thing and the Treasury mostly borrows shorter term anyway.
Interesting point. And this caution must feed into their thinking on quantitative tightening QT selling off the bonds they bought?
Yes, definitely. They're due to decide on the next annual pace of QT sales later this month. Currently, it's 100 billion yards a year. Bailey's tone suggests they'll likely continue a restrictive stance.
Which, for you listening, probably means continued pressure on borrowing costs and maybe a need for careful management of lending portfolios.
Exactly. Proactive customer engagement, careful risk assessment on new lending. It's a tricky balancing act.
Okay, let's turn to mortgages now. UK Finance's latest review showed lending bounced back a bit in June after a dip earlier in Q2.
Yes, that dip seemed linked to stamp duty changes. But the bigger ongoing story is the FCA's review of mortgage affordability stress test rules.
Yes, the rules designed to check if borrowers could cope if rates went up significantly. Always a hot topic.
It really is, because there's a fundamental tension. The current rules have kept mortgage arrears relatively low, which is good for stability. But they also restrict access to credit, particularly for first-time buyers. And that has social and economic consequences, too.
It's a real dilemma. UK Finance tried to quantify the risk of easing the rules, didn't they?
They did. Their modeling suggested that a modest easing could lead to about 175 extra loans falling into arrears for every 10,000 mortgages issued.
Which sounds small per 10,000, but scaled up. Is that still a comfortable number given the current economic climate?
That's the million-dollar question, isn't it? UK Finance argues for carefully measured easing. It implies any changes would need very careful handling by lenders reevaluating risk appetite, underwriting standards. It's about finding that sweet spot.
Definitely one to watch closely. Staying with the banking sector, there seems to be some nervousness about potential tax changes.
Yes, quite a bit of anxiety ahead of the budget on November 26th. UK Finance has put out a warning
What's the core concern?
that increasing the tax burden further on UK banks could hurt economic growth and make the UK less competitive internationally.
Is the argument that UK banks are already taxed more heavily than competitors?
That's exactly the point they're making. They argue the total tax rate here, especially for corporate and investment banking, is already notably higher than places like New York or Frankfurt, partly due to things like the bank surcharge sticking around.
And there are specific proposals floating about, like the IPPR idea for a levy on reserves held at the Bank of England.
Exactly, that's one causing concern. Deutsche Bank, for instance, estimated it could knock about 10% off UK bank earnings.
Ouch. So the strategic issue for banks is how this might impact investment, maybe in technology or customer service, if margins get squeezed further.
Precisely. It's that balance between banks contributing fairly to public finances and maintaining a stable, competitive environment that encourages investment and growth.
Okay, let's widen the lens now. National security is increasingly intersecting with finance. The government's new national security strategy, the NSS 2025, makes this explicit.
It really does. It frames national security as a shared responsibility and labels the financial sector a critical operational frontline.
Why operational frontline?
Because, as the NSS itself states, money is the fuel for almost every hostile activity. Financial institutions see the flows. That gives them a unique position and, well, a responsibility that goes beyond just ticking regulatory boxes.
So we're talking about threats like state-sponsored aggression,
Mhm.
organized crime groups. You mentioned examples like the Foxtrot network or that Minion spy cell plus cyber fraud, sanctions evasion. It's a complex mix.
A very complex mix. And these aren't abstract threats. They can manifest in transactions, in customer activity that banks might see.
And this ties into the regulatory side, too. HM Treasury has a consultation out on the money laundering regulations, the MLRs.
Yes, a 4-week technical consultation closing September 30th. It's proposing several tweaks.
Such as?
Things like adjusting customer due diligence thresholds, maybe raising the limit for simplified due diligence, clarifying what counts as an unusually complex transaction, also clarifying rules for pooled client accounts.
Anything else significant?
Yes, potentially narrowing the scope for enhanced due diligence, focusing it more specifically on countries flagged by the Financial Action Task Force, the FATF list, and aligning the regulation of crypto asset firms more closely with the main financial services framework, FSMA.
The industry reaction seems to be welcome, but the consultation window is very short.
That's the feedback, yes. A concern that 4 months isn't quite long enough to fully consider all the nuances, especially for retail banking operations. It's a chance to refine rules, but needs careful thought.
It feels like it's about making the system more effective against smarter threats, not just easing burdens.
That's the goal, integrating these changes into a broader security-aware risk approach, not just seeing them as compliance updates.
All right. Now, speaking of crypto assets, a really big development. The FCA is lifting its ban on retail investors buying crypto exchange-traded notes, ETNs.
Yes, effective October 8th. This is seen by many as a pivotal moment, a potential catalyst for a UK crypto boom, attracting investment and allowing regulated retail access to things like Bitcoin ETNs.
So this isn't the Wild West anymore. There are safeguards.
Well, the ban on high-risk crypto derivatives stays, but these ETNs will be classed as restricted mass market investments, or RMMIs. That means strict consumer protection rules still apply, risk warnings, appropriateness tests.
So for you in a retail bank, this means getting ready for customer questions, potentially new transaction types, understanding the risks involved.
Absolutely. Staff training, adapting systems, assessing the risks associated with these products and the underlying assets. It's a significant shift in the landscape.
And stay with the FCA, a reminder of their enforcement teeth, the sentencing of the West brothers for insider dealing.
A very clear message there. They made just over £44,000 profit, but were ordered to pay back over £280,000.
Why such a big difference?
The FCA pushed for confiscation based on the full value of the shares traded through their criminal conduct, not just the profit made. It aims to remove all the proceeds of the crime.
Steve Smart at the FCA put it bluntly, greed got the better of them. The West brothers knew the rules and still chose to break the law.
It really underlines that the MCA's surveillance systems are watching, And they will pursue cases vigorously to maintain market integrity. It's not just about the profit, it's about stripping away all the ill-gotten gains as a deterrent.
A strong deterrent message for anyone tempted to misuse inside information. Okay, that's a lot of ground covered. Here's where I think it gets really interesting. How do we pull these threads together?
What really strikes me is the sheer speed and interconnectedness. You have ONS data errors impacting economic outlooks, which influences Bank of England policy, which affects mortgage affordability debates, which run alongside tax concerns.
And overlaid on all that, you have this growing national security dimension demanding more from financial institutions, just as new asset classes like crypto are becoming more mainstream.
Exactly. The lines are blurring. Tax compliance, financial crime, national security, they aren't separate silos anymore. They all flow through the financial system. It demands a really integrated, adaptive response from you. Staying sharp means seeing these connections.
So what does this all mean for you listening? It feels like the core message is the need for constant vigilance, right? And developing strategies that are flexible enough to cope with this constant change.
Definitely. It's about moving beyond just box-ticking compliance towards genuine resilience and strategic awareness. Which leads me to a thought.
Cool.
Considering this convergence of financial crime, national security, and digital assets, what steps, both immediate and long-term, should your institution prioritize? How do you move beyond traditional compliance to really embed a national security-aware risk framework into day-to-day operations? Something to ponder.
A very pertinent question indeed. That's all from us this week. Thanks for listening to RegTalkUK. I hope this deep dive has helped you stay informed.
And hopefully provided some food for thought on navigating these complex changes. Remember to keep questioning and thinking strategically.
Until next time, stay sharp and stay compliant.